human resources executives at Huamei Optical are working overtime. The Taiwanese sunglasses and goggles maker is looking to hire 30 workers, many of them urgently for a new factory. Having based most of its production in China for more than 2 decades, Huamei is now expanding at home. A new plant in Taiwan, opened earlier this year, will create 180 jobs and is part of a plan to expand the group's footprint in higher-margin products. Huamei is not an outlier. Hundreds of thousands of Taiwanese companies are bidding farewell to China because of rising costs and trade tensions between Washington and Beijing, marking a dramatic transformation for Taiwan's corporate landscape with significant implications for global manufacturing. Hello everyone, welcome back to World of China, a channel to explore the real China. In today's video, we are talking about why hundreds of Taiwanese companies leaving China and what's their next stop. So stay tuned with us and give this video a big thumbs up. Taiwanese companies began shifting production to mainland China in the 1990s, a step ahead of their Japanese, US, and European rivals to take advantage of China's lower wages. Contract manufacturers including Foxconn and Quanta were a force behind this trend, which played a big role in turning China into a manufacturing powerhouse. About 70% of their production happens on the mainland. An estimated 700,000 to 1 million Taiwanese entrepreneurs have tried their fortunes on the mainland. A survey of 157 manufacturers by the Taipei-based Chinese National Federation of Industries, or CNFI, published in October 2020 found that COVID-19 had caused many Taiwanese firms to reconsider their reliance on China. Some 80% of respondents, mostly SMEs, said the pandemic had hurt their bottom lines. When the survey was conducted last summer, manufacturing capacity had recovered to above 70% for less than half of the respondents. Of the firms surveyed, 44% said they plan to expand production, while 60% said the tax credits might encourage their repatriation. Since the late 1980s, Taiwanese companies have received approval for an accumulated 191 billion of investments in mainland China, where they were tempted in part by cheaper operating costs. That makes the nation one of the biggest overseas investors in China, which is by far the Taiwanese group's largest destination for foreign direct investment. Their massive push into China has been both a blessing and a curse. Many early movers made freebie profits and enjoyed massive growth. Revenue at Apple supplier Foxconn had established its first factory in China in 1988, grew 65-fold to $3.5 billion in a decade after its 1991 Taiwan stock market listing, and ballooned to 5.3 trillion new Taiwan dollar last year. If it had not put manufacturing in China, the company would never have become the world's largest contract electronics manufacturer. Taiwanese executives say their large, low-cost neighbor was a natural choice for companies seeking to boost market share by expanding manufacturing while cutting costs. This is what we have all been doing for the last 30 years, and it now is what we are best at, said the chief financial officer of a Taiwanese electronics company. But now the scene is different. The option to simply relocate production to China to reduce operating costs has meant many companies have shirked more sustainable ways of increasing competitiveness. Because we speak the same language and in China the cost is low, they forgot to transform themselves, doing higher value-added products, building their brands, and now is a critical time for a change, said CY Huang, a Taipei-based investment banker. Taiwanese companies' default strategy has been undermined by Washington's trade war with Beijing and efforts to pry China out of global supply chains. Most of Taiwan's leading contract electronics manufacturers are now relocating parts of their supply chains to Southeast Asia and India, as well as back home. Small and labor-sized enterprises and industries including textiles, shoes, furniture, car parts, and machine tools, some of which had shifted almost their entire business to China in recent decades, have also come under pressure. Labor costs have risen, and Beijing no longer offers incentives to these industries, which also must contend with tougher competition, intellectual property theft, and China's increasingly dictatorial and nationalist policies. As a result, annual investment flows from Taiwan to China have been in decline since peaking in 2010, the year Beijing and Taipei signed a trade agreement. Last year, China-bound FDI more than halved. Since 2017, Taiwanese companies have been remitting more money home from the country than they sent there. Honda, a Taiwanese car parts maker and Tesla supplier that has focused production in China since 1999, is now expanding operations at home. The company is building a new plant in Chiayi in southwestern Taiwan that'll serve markets other than China from next year. Chris Ruffle, a veteran Taiwan investor, said, quote, "Overall, I've seen Taiwanese companies diversifying or de-emphasizing mainland investment, and there are companies who cannot or will not invest there. But I think there are a few examples of companies which operations there totally given up. The lure is now to a huge potential market and no longer the cheap labor force." Taiwan Semiconductor Manufacturing Company, the world's largest contract chip maker, has decided to build a new plant in the US. New restrictions on exports of US chip-making technology have raised hurdles to TSMC's ability to serve as a chip-making partner to Huawei. Taiwanese companies, long caught between their home's political ties with the US and economic links on China, are not immune to the negative impact of the trade war between the world's two biggest economies. Taiwan's efforts could serve as a test case for global attempts to rethink supply chains in light of the trade war and the coronavirus pandemic. Other leading Taiwanese electronics manufacturers are deploying fresh capital on the island. Innolux, a display panel maker owned by Apple supplier On High Precision Industry, or Foxconn, is investing an additional 70.1 billion new Taiwan dollars in Taiwan. It manufactures core parts in Taiwan to be assembled in China, but plans to start producing some products entirely on the island. It's building a factory in the city of Tainan that'll be almost entirely automated. Some Taiwanese companies are exploring new strategies. Hota, for example, is investing in other car parts makers to diversify its business. Technology companies are also stepping up acquisitions. Global Wafers, a manufacturer of silicon wafers used by chip makers, in December agreed to acquire German rival Siltronic, strengthening its position in Europe. In June, component maker Yagyo bought smaller US competitor Kemet in a deal that could make it less vulnerable to cyclical trends in the electronic industry. Mr. Huang, the investment banker, said, "Taiwan's corporate sector needs to broaden its traditional focus on contract manufacturing. The China option has put us on this track of serving our master, and we have been doing that too well. We have been content with leaving 95% of profits to our customers. That is a slave mentality. What is left for Taiwan at the end of the day?" If we look back, we see about 700 billion new Taiwan dollars was invested in 2019, 5 times as much as it was approved for investment in mainland China for the year, although applications tend to cluster in incentive programs first year. Meanwhile, Taiwanese investment flows to the mainland halved in 2019. The US imposed a 10% tariff on Chinese-made servers, communications equipment, and other electronics in September 2018, and then raised the level to 25% in May 2019. Products made in Taiwan were not subject to the punitive tariff. Taiwanese authorities have played a significant role in drawing Taiwanese companies back to the island. President Tsai Ing-wen, eager to reduce Taiwan's economic dependence on the mainland, introduced new investment incentives in January 2019. The package includes eased restrictions on foreign labor and helps pay interest on private sector loans. Companies need only fulfill certain requirements, such as having invested on the mainland for 2 or more years or be suffering from trade tensions between the US and China. Well, that's all for today. Thanks for watching this video. If you've enjoyed this video, then give this video a big thumbs up and share it. For more exciting videos, subscribe to this channel and hit the bell icon. I'll be back with another exciting video soon. Till then, check out our channel for more exciting videos and stay tuned. Watch the full story of why major foreign companies are leaving China's market. The link is in the description below.